In late August 2025, a powerful wave of optimism swept through Asian financial markets, creating a buzz that was impossible to ignore. The atmosphere was electric as investors, traders, and analysts watched stock prices surge to new heights across the region. This surge sent stock prices soaring, with major indices in cities like Tokyo, Hong Kong, and Singapore all posting impressive gains. The rally was not just a blip, it was a sign of renewed faith in Asia's economic prospects. From Shanghai to Seoul, investors celebrated as their portfolios grew, and financial advisors fielded calls from excited clients. The mood was one of hope and anticipation, signaling a fresh wave of confidence in Asia's economic future. But this wasn't just a random spike in the markets. Two major forces were at work, fueling the rally and drawing attention from around the world. The first force came from across the Pacific. Hints from the U.S. Federal Reserve about potential interest rate cuts sparked excitement among global investors. Lower rates mean cheaper borrowing, which can boost spending and investment, not just in America, but worldwide. The second force was closer to home, China's booming tech sector. Innovative companies were making headlines with breakthroughs in artificial intelligence, green energy, and digital finance, igniting investor enthusiasm and attracting fresh capital into Asian markets. These developments acted like sunshine after a long drought, reviving markets that had been sluggish and drawing the eyes of the world to Asia's financial centers. The stock market, often described as a giant marketplace of hopes and fears, thrives when investors feel good about the future. In August, that optimism was palpable. Traders were energized and the mood was infectious. Lower borrowing costs and China's relentless tech innovation created a powerful incentive to invest in Asia, making the region a magnet for both local and international capital. The rally was a vivid reminder of how interconnected our world has become. Decisions made in Washington and breakthroughs in Beijing can send ripples from Tokyo to Mumbai, affecting millions of investors. By understanding these events, we get a front-row seat to global economics in action, seeing how policy shifts and technological leaps shape the fortunes of entire regions. This story unpacks why U.S. interest rates matter so much to Asian markets, how China's tech ambitions are not only reshaping its own economy, but also influencing global investment trends, and what all of this means for new investors looking to understand and participate in Asia's growth story. Let's break down the puzzle behind Asia's remarkable rally, piece by piece, to see how global forces and local innovation combined to create this extraordinary moment. The stage was set for a week that would not only redefine the region's financial landscape, but also offer valuable lessons for investors everywhere. The U.S. Federal Reserve, or Fed, played a crucial role in Asia's rally. While it's an American institution, its influence stretches far beyond U.S. borders, shaping the flow of money and investment around the globe. The Fed's decisions are watched closely by investors, governments, and businesses everywhere, because what happens in Washington can quickly ripple out to the rest of the world. The Fed controls interest rates, which affect how expensive it is to borrow money. When rates are high, loans for homes, cars, and businesses cost more, slowing down spending and investment. When rates are low, borrowing becomes cheaper, encouraging people and companies to spend, invest, and take risks. In August, Fed Chair Jerome Powell hinted at possible rate cuts, a signal that electrified global markets. Investors everywhere began to anticipate a new era of easier money, and the financial world started to reposition itself for what might come next. Lower U.S. rates make American dollars less attractive, prompting big investors to seek better returns elsewhere, often in Asia. As the yield on U.S. assets drops, global funds look for new opportunities, and fast-growing Asian economies become a magnet for this capital. Think of it like moving your savings to a bank with higher interest. Global investors do the same with their money. They constantly compare where their money can work hardest, and when the U.S. offers less, they look to places with more potential. This shift drives up stock prices in places like South Korea, China, and Japan. As more money pours in, demand for shares rises, pushing markets higher and creating a sense of optimism among local investors. The mere suggestion of a rate cut was enough to send waves of capital into Asian markets. Even before any official move, the expectation alone can trigger massive shifts in global investment flows. Suddenly, Asian stocks looked more valuable, and investors rushed in. Trading floors in cities like Shanghai, Seoul, and Tokyo buzzed with activity as foreign money arrived, eager to catch the next big rally. the Fed's decisions ripple worldwide, not just in America. A single policy change can alter the direction of markets from New York to Mumbai, from London to Hong Kong, showing just how interconnected the world's financial system has become. The expectation of cheaper money encouraged risk-taking and investment in Asia's growth markets. Companies found it easier to raise funds, entrepreneurs launched new ventures, and investors became more willing to back bold ideas. This was the foundation for the region's powerful rally. The combination of global capital and local ambition set the stage for a surge in stock prices and economic activity. Combined with China's tech surge, it created perfect conditions for a market boom. The world's attention turned to Asia, where innovation and investment were coming together in a powerful way. The world's financial system is deeply linked. One central bank's move can lift markets continents away. This web of connections means that decisions in Washington can spark rallies in Tokyo, Seoul, or Shanghai almost overnight. Investors everywhere watched the Fed, knowing its choices could shape their fortunes. Every word from the central bank was analyzed, every hint dissected for clues about the future. The promise of lower rates was a green light for Asia. It signaled opportunity, growth, and the chance for investors to ride a new wave of prosperity. The rally's first piece fell into place, setting off a chain reaction that would reshape markets and fortunes across the region. While the Federal Reserve set the initial tone for global markets, all eyes quickly shifted eastward as a new story began to unfold. China and Hong Kong, two of Asia's most dynamic financial centers, suddenly stole the spotlight with a surge that caught many by surprise. Chinese stock indexes soared to new heights, with the CSI 300 reaching its highest level in years, and Hong Kong's Hang Seng jumping over 2% in a single session, an impressive move that energized investors worldwide. This surge was powered by a remarkable rally in technology stocks. Companies specializing in artificial intelligence, semiconductors, and other high-tech sectors led the charge, reflecting years of innovation and investment. Investors, both local and international, bet big on China's tech sector, seeing it as a future global powerhouse. Their confidence fueled a broad-based boom that extended beyond just a handful of companies. Major banks and financial institutions responded by raising their targets for Chinese and Hong Kong stocks, signaling their belief that the rally had plenty of room to run and that the momentum was just beginning. Years of strategic investment in technology and innovation by China appeared to be paying off, and a wave of optimism spread rapidly across Asia's markets, inspiring confidence in the region's economic future. The tech rally in China and Hong Kong didn't just lift local markets, it became the engine driving growth across the entire region, setting a new pace for Asia's financial landscape. This was more than just a local success story. It was a powerful signal that Asia's future was being rewritten, with technology and innovation at its very core. A key catalyst was Beijing's push for self-reliance in semiconductor chips. The government urged tech firms to use locally made chips, reducing dependence on U.S. technology. This move came as Nvidia resumed chip sales in China, but Beijing doubled down on its self-sufficiency message. The policy shift promised a surge in demand for Chinese chipmakers, electrifying their stocks. China's ambition: control its tech destiny and create a protected market for its own innovators. Investors saw a golden opportunity and poured money into domestic chip companies. The government's chip push created new market stars. SMIC, China's top chipmaker, saw its stock soar over 6% as investors anticipated booming demand. DeepSeek, a major AI developer, launched a new model optimized for local chips, proof the policy was working. Huahong Semiconductor and Cambricon Technologies also surged, with Cambricon hitting a record high. The rally wasn't just about manufacturers, designers of next-gen AI chips were in the spotlight too. These companies became symbols of China's tech ambitions and investor confidence. Their soaring stocks reflected belief in massive future growth. Government support and real demand created a perfect storm for these firms. The market's excitement was grounded in tangible progress. The optimism in China and Hong Kong rippled across Asia-Pacific. Japan's Nikkei rose 0.7%, fueled by global optimism and hopes for more investment. South Korea's Kospi jumped 1%, benefiting from both tech excitement and pro-Asia sentiment. Australia's ASX 200 edged higher, as a strong China means more demand for its exports. Even Singapore's market joined the rally, reflecting broad regional confidence. The rally showed how interconnected Asian economies are. Global trends and China's strength lifted all boats. Each country's market responded to its own mix of global and local factors. The late August surge was a regional wave, not just a local event. Asia's markets moved together, powered by shared optimism. India's market told a different story. While Asia boomed, India's Nifty 50 gained just 0.3%, held back by looming U.S. tariffs. The U.S. threatened a 50% tariff on Indian goods, targeting India's Russian oil purchases. This clouded investor sentiment, especially for export-focused companies. The risk of lost sales and slower growth made investors cautious. India's experience was a reminder: local risks can outweigh global optimism. While neighbors soared, India's market lagged, anchored by geopolitical uncertainty. What can new investors learn from August's whirlwind? Stock markets move on stories about the future. Expectations of cheaper money and tech breakthroughs drove prices up. Two forces matter most: global monetary policy and innovation. The Fed's rate hints lifted all of Asia, while China's tech push created huge winners. Understanding these big trends is key, even if you don't know every detail. India's caution showed why watching local risks is crucial. Diversification, spreading investments, protects against surprises. August 2025 was a real-world lesson. Follow global trends, watch for tech shifts, and never ignore local risks. As September begins, the big question is, can the rally last? All eyes are on the next Fed meeting. Will they cut rates as expected? In China, investors want proof that chip and AI companies can deliver real results. India's fate hinges on the outcome of its tariff dispute with the US. The landscape has shifted, volatility is likely, and staying informed is key. The combination of supportive policy and tech innovation has created a compelling growth story. The coming months will reveal if August optimism marks the start of a new era. For investors, the next chapter is about watching the drivers and being ready for change.